Hello everyone and welcome back to our new video, which is episode 17. Some of you might not fully grasp the technical knowledge presented in this video on your first watch. If needed, feel free to watch it multiple times to absorb everything and fully understand the concepts hidden within these chapters. The concepts in these chapters are some of my favourites. In particular, this one and the next one have been significantly influenced by my technical knowledge, and I use them daily in both higher and lower timeframes on my analysis. I apply these concepts to build a higher timeframe narrative, a lower timeframe narrative, and most importantly, to determine draw-on liquidity on both timeframes. It's essential to take the next two chapters seriously. At first, the concepts might seem a bit ambiguous, but as you dig deeper and familiarise yourself with them, you'll find yourself analysing charts, especially higher timeframe charts, with a sharper perspective and a more refined understanding. With that said, let's dive into this part of the video, Chapter 17, which we will focus on weekly profiles. First, as always, I'm going to start by introducing what we're dealing with and defining it as clearly as possible. This will give you a better understanding of the episode's focus and will help you follow along throughout the video. To begin, weekly profiles are a more advanced type of market profile. Now let me explain what I mean by advanced. If you've watched my previous chapters on market profiles, you'll remember that those primarily focus on price and discuss only price aspects on the chart. However, with weekly and intraday profiles, we take market profiles a step further by incorporating the time aspect of charts alongside the price aspect. This is why I describe weekly profiles as an advanced type of market profile. Unlike traditional market profiles, which only consider price, weekly profiles include both time and price. This dual consideration is why I find this concept so exciting. Weekly profiles are dynamic because they encompass both aspects of the chart. Essentially, weekly profiles allow us to break down the range of a weekly candle into manageable segments, each with its own unique fractals. What this means is that with the weekly profiles, we divide the weekly candle's range into smaller segments, and each segment will have its own characteristics or fractal nature. This fractal nature is dynamic, subject to change, and adjustable. There's no fixed black and white framework when working with weekly profiles. Instead, you'll need to consider a combination of key levels, the PD matrix, and dealing ranges to draw meaningful conclusions. As I've mentioned before, these concepts only work effectively when integrated within a logical framework. Weekly profiles, like all of the concepts that I've been showing you, are no exception. They don't work in isolation, but they need to be correctly combined with key levels, market profiles, and related concepts like the PD matrix to be truly effective. Let's move on to the next slide and discuss the importance and significance of weekly profiles as well as the way they assist in market analysis. Weekly profiles are invaluable for understanding the weekly candle's range, specifically the open high-low close or the open low-high close. By analysing these factors, we gain a refined and logical perspective on the weekly range. The OHLC-OLHC concept is crucial and I have covered it in greater detail, so definitely go check that video out if you haven't done so yet. For now, it's essential to understand that weekly profiles help us break down and analyse the weekly range more effectively. In addition to providing a clearer view of the weekly candle, weekly profiles also allow us to divide the weekly candle range into multiple segments, each with unique fractals and characteristics. This segmented approach enables a more detailed and nuanced analysis, helping traders better understand the market structure. Another significant benefit of weekly profiles is their role in determining daily bias or draw on liquidity. The process of identifying daily bias does warrant a full chapter, which will be covered later. It's important to note that the weekly profiles provide the foundation for this analysis by organising the market data in a logical framework. Weekly profiles are also essential for building a higher timeframe narrative. They help us understand the market's broader context, including where the price currently is, where it has come from, and where it might go next. This process of building a narrative is key to identifying trends and potential price movements. Once a high timeframe narrative is established, it can be refined and applied to lower timeframes to pinpoint trade entries. Moreover, Constructing a narrative enhances conviction and confidence in trade ideas and analysis. In addition to narrative building, weekly profiles assist in identifying draw-on liquidity targets. This becomes particularly effective when weekly profiles are combined with key levels and the PDRM matrix, creating a comprehensive and integrated approach to market analysis. Finally, weekly profiles introduce the time aspect of the charts, which is an essential factor for deeper market analysis. While this episode will only scratch the surface of the time concept, we will explore it in much greater detail. So turn on my notifications so you don't miss out. As we move through these chapters, not only am I explaining the current concepts, but I'm also introducing ideas that we will dive into further, such as daily bias, open high-low close, and time analysis. These foundational ideas will play an increasingly important role as we continue to build on them in the future. Now, let's discuss the various concepts we'll be using alongside weekly profiles to create a logical and effective framework. These supporting elements are essential for making weekly profiles meaningful and actionable. First and foremost, we have key levels, which are critical to the structure and interpretation of weekly profiles. Key levels provide the foundation upon which weekly profiles are built, giving them purpose and clarity. Next, we have market profiles, which, as I mentioned earlier, are the foundation of weekly profiles. Weekly profiles are essentially an advanced form of market profiles, meaning they are derived from them. Within a higher time frame weekly profile, you'll still find multiple market profiles embedded. This interconnected relationship between the two concepts adds depth and flexibility to our analysis. We'll also be using the PDRM matrix to refine the key levels that we align with the price in order to define the weekly profiles. The PDRM matrix helps us filter and adjust these key levels, distinguishing those in premium and discount zones. These refined key levels will then be matched with the price action to construct specific profiles, which will be further categorized based on the day of the week. Lastly, we'll incorporate dealing ranges to assist in segmenting and organizing the weekly candle into actionable sections. By merging key levels, price action, and dealing ranges, we can frame accurate and effective weekly profiles that guide our understanding of market behavior. Now let's move on to some more important points regarding weekly profiles. One key aspect is the role of Monday's price action, particularly Monday's candle, in determining and framing the weekly profile. The behavior of the Monday candle plays a significant role in shaping the weekly profile for the rest of the week. Before the weekly candle opens, it's not possible to anticipate or frame a weekly profile with certainty. Only after observing Monday's price action can you gather the necessary information to decide on the weekly profile. This involves assessing whether Monday's candle has tested a key level, formed a CRT, or demonstrated other significant characteristics. Based on this evaluation, you can decide how to frame a specific weekly profile for the rest of the week. It's important to note that weekly profiles are dynamic and adjustable. They can change throughout the week, depending on how price action does evolve. The flexibility means that there's no rigid or black and white framework for weekly profiles. Instead, they should be treated as fluid concepts that adapt to the behavior of the market as the week progresses. Adjustments to weekly profiles are made in response to the price interactions with key levels and overall formations of the price action. This adaptability underscores the importance of maintaining an open-minded approach when working with weekly profiles. Another valuable tool for refining weekly profiles is the news calendar. News events can significantly influence price action, and understanding these events can help frame the most accurate weekly profile. We will dive into this aspect in future discussions. Here we have some of the key weekly profiles. Keep in mind that these are not the only weekly profiles available, but they are the ones that I rely on most to frame a narrative or develop a weekly profile throughout the week. These particular profiles tend to play out most of the time, and if you stick to them as I do, this should be more than sufficient to achieve consistent accuracy in your analysis. Now let's dive in to each of the profiles in detail and explore their intricacies. By understanding these profiles thoroughly, you'll be able to apply them effectively and integrate them into your framework with confidence. The first profile we will discuss is the classic expansion weekly profile. In this profile, the week begins with the Monday candle forming a relatively small range. Monday's price action tends to be more contained, creating what appears to be a ranging candle. On Tuesday, price typically expands beyond Monday's range, taking out Monday's high or low. During this expansion, price often tests a higher timeframe daily or weekly key level. On Tuesday, for an upward scenario, price typically tests a discount level before closing higher. From this point onwards, price continues to move higher throughout the week, targeting the draw on liquidity. In most cases, the draw on liquidity is reached on Thursday, but sometimes it can extend into Friday. If the draw on liquidity is reached on Thursday, Friday's candle is likely to react as a retracement. However, if the liquidity target is reached on a Friday, specifically during the London or New York sessions, Friday's candle often becomes a reversal, which manifests as a high timeframe retracement. This profile segments the weekly candle into distinct phases, each corresponding a specific day of the week. For example, Monday sets the initial range, Tuesday establishes the high or low of the week, and Thursday or Friday marks the liquidity draw or reversal. Each segment has unique fractals, defined by price reactions to key levels on the higher time frame. In the bullish version of the profile, the low of the week is usually formed on Tuesday, while the high of the week is established on Thursday or Friday. For the bearish scenario, the high of the week is typically formed on Tuesday, and the low of the week is formed on Thursday or Friday. Additionally, the open high-low close structure of the weekly candle is clearly outlined within this profile. Understanding how the body and wicks of the candle are formed allows you to identify potential opportunities to exploit each segment of the week. This systematic approach enhances both precision and confidence in trading decisions. Let's examine how the weekly candle is broken down into various lower timeframe market profiles. The week often begins with Monday showing a ranging profile. This is typically a period of consolidation with less volatile price movement. On Tuesday, the market frequently transitions into a manipulation profile. During this phase, price tests a higher timeframe key level and manipulates market participants to establish either the high or low of the week. As the week progresses, Wednesday and Thursday tend to exhibit an expansion profile, and during this period, price makes significant moves towards the draw on liquidity or the opposing higher timeframe key level. This serves as a target for the week. Once this key level is tested, the market often shifts to a retracement profile on the Friday. This represents a pullback or reversal as the week concludes. For those familiar with market profiles, the classification of these profiles might seem unclear at first. The most refined way to classify them is by using time, specifically the days of the week. Each day can be associated with a distinct market profile, making the approach both practical and effective for understanding weekly price behavior. Typically, Monday aligns with a ranging profile. Tuesday often displays characteristics of manipulation, where key levels are tested and the highs or lows of the week are established. Then Wednesday and Thursday follow with an expansion profile, driving price towards liquidity targets or key levels. Finally, Friday generally reflects a retracement profile as the market pulls back from its liquidity target or high timeframe levels. This time-based segmentation of the weekly candle into distinct market profiles provides a clear and structured framework. It allows for better alignment of analysis and strategy with the evolving market narrative throughout the week. Now let's utilize how this weekly profile would appear on the daily time frame. In this example, the two horizontal lines represent higher time frame key levels. The sequence begins with Monday's candle, which is typically a ranging candle that does not test any significant key level. The lack of interaction with critical levels reinforces its consolidative nature. On Tuesday, the market shifts dynamics as the candle breaks out of Monday's range and tests the higher timeframe key level. This movement establishes Tuesday as the pivotal point where manipulation occurs, setting the stage for the rest of the week. Following this, Wednesday and Thursday's candle exhibit an expansion phase. Price pushes higher, moving decisively towards the draw on liquidity or the opposing high timeframe key level. By Thursday, the liquidity target or key level is reached, marking a significant completion of the week's directional movement. As a result, Friday's candle often transitions into a ranging profile or retraces lower. This retracement reflects a pullback following the fulfillment of the week's primary objective, as defined by the interaction with the key levels on Thursday. This structured progression highlights the distinct roles played by each daily candle within the weekly narrative. Now, let's explore the second variation of the classic weekly expansion profile. While it follows the same general principles as the classic expansion profile discussed earlier, the key distinction lies in the timing of the high or low of the week. In this case, Monday itself initiates the week by testing a higher timeframe key level. Unlike the previous example where Tuesday played this pivotal role, here the weekly movement starts immediately with Monday's candle engaging with a critical level. As mentioned earlier, you cannot anticipate the type of weekly profile right from the outset. You need to observe Monday's price action to determine the possible weekly narrative. Whether Monday will test a key level or whether Tuesday will play that role becomes clear only after price action unfolds. Your job is to analyze the initial movements and then frame a logical weekly profile based on what price reveals. In this particular scenario, Monday begins by testing a higher timeframe key level. From there, the market embarks on a journey towards the opposing key level or draw on liquidity. The weekly objective is met as price progresses towards its target. Once the weekly objective is achieved, we often observe a retracement candle. In this example, Wednesday provides a retracement before the price expanded higher. This highlights the natural behavior of the markets, as price rarely moves in a straight line, but instead forms distinct market profiles and cycles within its overall structure. Here, the weekly candle is broken down into lower timeframe market profiles, offering a clearer picture of the market structure. In this scenario, Monday begins by immediately testing a higher timeframe key level. Following this, Tuesday and the rest of the week demonstrate expansion profiles marked by periods of strong movement towards the draw on liquidity or opposing key level. These expansions are interspersed with retracements that serve to rebalance the price action within the overall trend. As the week progresses, often the opposing key level or liquidity zone is typically reached either on Thursday or Friday. Once the target is achieved, the price reacts by retracing lower. However, if the weekly objective is reached earlier, such as on a Wednesday, then the high of the week would likely be formed on that day. In this case, Thursday and Friday's price action would primarily consist of a retracement phase consolidating after the week's primary move. The key is to monitor price action as it approaches the higher timeframe key level. Once this interaction occurs, you can finalize the weekly profile and establish a coherent narrative. This narrative is constructed within a logical framework, aligning the observed price movements with the anticipated weekly structure, enabling effective analysis and strategy planning. Here's how it would look on the daily chart. Monday starts off testing a higher timeframe key level, and then it expands higher. Here, we encounter another intriguing and slightly more advanced weekly profile. Unlike the previous examples, the price cannot be anticipated from the outset. Instead, it requires observation of how price action develops on a Monday and Tuesday before framing the profile. In this type of weekly profile, the price initiates a modest expansion on Monday, but this expansion tends to be weak as it originated without interacting with a higher timeframe key level. Due to this lack of key level interaction, the Monday candle often forms a CRT. On Tuesday, the price action typically consolidates, with the Tuesday candle forming a ranging profile or inside bar within the CRT range. The real price action unfolds on Wednesday when the price breaks out of the CRT range, testing a higher timeframe key level. After this test, the price reverses direction and begins a robust expansion. The movement from Wednesday onwards drives the price higher, targeting the opposing end of the range and eventually reaching a higher timeframe key level. This opposing key level, located within the dealing range or defined by PDRM matrix, marks the weekly objective. In summary, Monday's candle formed a CRT, and Tuesday's candle consolidates within that CRT as an inside bar. On Wednesday, the CRT range is breached and the price initiates a significant expansion that progresses into Thursday, reaching the weekly objective by hitting a higher time frame key level. This structured progression underlines a fundamental principle. Each candle, whether daily or weekly, starts by engaging with one key level that concludes its movement by reaching an opposing key level, fulfilling its inherent objective. In this profile, the higher time frame key level is tested midweek, typically on Wednesday, and the ultimate objective, a higher time frame opposing key level, is achieved by Thursday or Friday. This sequence emphasizes the importance of observing and analyzing price behavior dynamically, enabling you to construct an effective and logical narrative for trading. Here is how this particular weekly candle would manifest when analysed through lower timeframe market profiles. The sequence begins on a Monday, where price action initiates a weak expansion profile. This expansion lacks robustness as it originates without engaging with a higher timeframe key level. Following this, Tuesday's candle tends to be a ranging candle, often forming an inside bar within the CRT range established on Monday. On Wednesday, a pivotal shift occurs. The price manipulates below the CRT range formed on Monday and tests a higher timeframe key level. This key level interaction is the catalyst for significant expansion upwards. From this point onwards, the price starts its upward movement, heading towards the draw on liquidity, typically an opposing high timeframe key level. This process demonstrates the logical framework needed to capture a weekly expansion effectively. The first step is waiting for the price to test a higher timeframe key level on one side of the range. Once this test occurs, the next step involves looking for the lower timeframe confirmations, such as a change in state of delivery or a shift in market structure. These confirmations provide the signal to position yourself towards the draw on liquidity, exploiting the weekly range. In this profile, Tuesday's candle is generally not a trading opportunity due to its lack of purge or meaningful interaction with key levels. Instead, patience is exercised until Wednesday, when the CRT purge takes place. At this point, the focus shifts to the 4-hour CRT confirmation, signaling the moment to position yourself towards the higher timeframes draw on liquidity. This calculated approach ensures precision in exploiting the weekly's range while minimizing risk. Here's how it would look on the daily timeframe. You can see that Monday's candle is a CRT, Tuesday is an inside bar, and Wednesday's candle purged the CRT, and then it expands higher. And again, the draw on liquidity is reached either on Thursday or Friday. This advanced type of weekly profile demonstrates the necessity of flexibility and the ability to adjust based on the unfolding price action throughout the week. As emphasized earlier, weekly profiles are dynamic, meaning they cannot be rigidly defined at the beginning of the week, but must be constructed as price develops. In this profile, the week begins with an expansion on Monday. However, this expansion is weak because it originates without testing a higher timeframe key level. This weakness often results in Monday's candle forming a CRT. On Tuesday, price tends to consolidate, typically forming an inside bar without any significant movement. Wednesday then becomes a critical day in shaping the narrative. In some cases, the price will take out the high of Monday's CRT and expand lower. Alternatively, it might consolidate within the CRT range without any significant move. Thursday often serves as the decisive day in this profile. In one variation, the price manipulates below Monday's CRT, tests a higher timeframe key level, and then expands higher towards the draw on liquidity. Another possibility is that the price consolidates from Monday through Wednesday without breaking the CRT range, and only on Thursday manipulates below the range before expanding higher. This expansion could be triggered by high-impact news events such as CPI or PPI, which inject volatility into the markets. Even within this weekly profile, variations can occur. For instance, Monday's candle might not form a CRT, but instead create a simple ranging structure with the consolidation continuing until the end of Wednesday. On Thursday, the price manipulates below this range and then expands towards the liquidity. In another scenario, if there are external factors like bank holidays, the market may lack volatility until Thursday when a news-driven catalyst spurs an expansion. Despite these variations, the core narrative remains intact. Price reacts and tests high timeframe key levels before progressing towards the weekly objective. The logical consistency of this profile is maintained regardless of how the individual days play out. This adaptability is essential for traders, and the framework allows for systematic anticipation of price behavior. By thoroughly backtesting and analyzing these scenarios, traders can develop confidence and precision in identifying and trading such weekly profiles. Here is how it would look based on market profiles. On Monday, price forms an expansion. Tuesday is basically a range, and then on Wednesday, price takes out the Monday CRT high and expands lower. Then on Thursday, we test a higher timeframe key level and reverse from there. Here's how it would look on the daily timeframe. You can clearly see that we had this CRT, then we purged that CRT on Wednesday, and after that, we purged the other opposing end of the CRT range on Thursday. Then we expanded higher. You can also imagine how the weekly profile would look based on what I just explained. This is exactly how you frame a narrative and a weekly profile on the higher time frame. Remember, you would never use this alone. Instead, you'll combine it with all other concepts and incorporate time with it. Only then will it work. This is basically an introductory concept to the topics we'll discuss within this mini-series. So that's weekly profiles covered in today's episode, and next week we will be going through intraday profiles, which are even more important. So stay tuned for that, and turn on notifications.